Many of us have probably described ourselves as broke or poor at one point or another, but very few people have a sense of what real poverty feels like. The simple definition of poor means not having enough money to cover the cost of living. But the cost of living from day to day is actually more expensive for the poor.
Huh?
Sounds like an oxymoron, doesn't it? But it's a real phenomenon, and there's actually a name for it: the poverty penalty or ghetto tax. It's not tax in the literal sense, but a situation where people pay more money for the same goods or services just because they are poor or live in a poor area. In today's video, we will highlight some of the hidden costs and financial traps and share some steps you can take to take control of your finances. Let's start with the largest expense for Americans: housing. Affordable housing for low-income household averages around $806 a month in California and $572 a month in Arkansas. Most landlords want your first month and last month rent as a security deposit. Plus, you have to have enough money to pay for the first month's rent and the application fee. This means to rent a place for $572 in Arkansas, you actually have to have at least $1,716 in your bank account to pay for your landlord upfront before you even move in. And for people barely scraping by, this is an impossible amount of money. And even if you finally saved enough to cover the deposits and the first month's rent, you may not be considered a good candidate to the landlord because most places require proof of stable income like pay stubs. And this is especially hard for those working odd jobs to make ends meet. Some people have no choice but to turn to low-end extended stay motels, so they can just pay for shelter on a day-to-day basis. These places typically don't require security deposits or financial background checks. But in the long run, the cost is way more than an apartment. And these low-end extended stay motels often don't have in-unit laundry, so they pretty much have to spend time waiting at a laundromat. And these places also don't have kitchen, so people have to rely on fast food, which can seem cheap in comparison, but is actually more expensive than cooking at home. And when it comes to food, low-income and inner-city neighborhoods generally have limited access to fresh and affordable foods like fruits and vegetables. The sad truth is that it's not profitable for big supermarket and retailers like Costco, Safeway, or Walmart to open in these areas because shoppers have less money to spend. This is known as the food desert, where a large percentage of the population lives more than 1 mile away from a large food retailer. It's very difficult for someone relying on public transportation to haul groceries on buses or walks. And the only options to buy food in these areas are convenience stores, bodegas, local mom-and-pop shops, or gas stations. Another reason people may not like to talk about it is that in these neighborhoods, there is higher rate of crime and theft. Chicago, for example, had at least 6 grocery stores closed within the last 2 years. Washington, D.C. faces the same issue with giant retailers closing due to crime. The way big retailers operate is based on low margin and high volume. So the risk factor and the overhead costs of loss prevention are too high to operate in these areas. Now, the problem is that the smaller stores don't have enough purchasing power to offer low prices, so people have to pay more. A public health research shows that the price of produce from small food stores to be 11 to 53% more expensive than the nearest supermarkets. Not only is food more expensive, people in lower income brackets also spend more on goods. Those living paycheck to paycheck may only be able to afford the cheapest version of whatever they need to buy. Let's say if you need to replace tires on your car, but you only have enough money for the inferior off-brand version. It will probably wear off faster than the more reputable or higher-end version. And yes, maybe you only spend $200 instead of $400. But the $200 tire set may only last for 2 years, and then you need to spend again to replace them. The more reputable brand may last for 5 or 6 years. $400 once is cheaper than spending $200 3 times. And there is a popular economic theory called the boots theory, which states that people in poverty have to buy cheap and subpar products that need to be replaced repeatedly, proving more expensive in the long run than more expensive and quality items. The boots theory applies not just to material goods, but other small fixes in life as well. Some people may ignore a sore tooth because they can't spare a few $100s to visit a dentist. Then later, they are in a great deal of pain and need an emergency root canal for $1,000. Someone in lower income, counting every penny, may end up in debt over the larger bills. Then there's banking. It's really hard to get by if you don't have access to basic financial services like bank accounts and ATM. The way banks make money off of your deposit is to make loans to other people and businesses. The less money you have, the more you will need to pay for these services in the form of monthly service fee. For example, if you don't have a direct deposit set up with your employer or a government benefit payment, Bank of America will charge $12 monthly service fee unless you maintain $1,500 minimum balance in your checking account. It's even more with Wells Fargo, which requires $20,000 minimum balance. Otherwise, you will need to pay $25 each month to maintain the account. And if you don't have enough money in your checking account to cover a transaction, some banks charge up to $35 in overdraft fees for each item. The three biggest US banks, Chase, Wells Fargo, and Bank of America, made a combined $2.2 billion in just overdraft fees in 2023. For people living hand to mouth, overdraft fees are hard to avoid. Big banks are known to take advantage by reorganizing customers' transactions, deducting big transactions first, so smaller transactions would trigger multiple overdraft fees when there's not enough money in the account. This means if you didn't realize that your account has $5 left and you went and bought a $12 Big Mac meal, this Big Mac meal could end up costing $45 because of overdraft fees. Then there's the out-of-network ATM fee. If you withdraw $20 from an out-of-network ATM, you need to pay $2.50 plus fees charged by the ATM operator. That's more than 13% in fees. And let's say if you need to take out $100 but can only take out $20 at a time. The fees can quickly add up. People in low income brackets can end up paying hundreds of dollars a year just to access their own money, which wealthier people enjoy for free and often take for granted. All these excessive fees add burden to low-income families already struggling financially. No wonder the low-income families avoid banking altogether. According to FDIC, 5.9 million households in the US are unbanked. If you're living under the poverty line, you may not be able to pay all your bills all the time. And if you rely on credit cards to get by, this can mean late or no payments on your credit card bill. And these are major factors resulting in a poor credit score. Study shows that lower income earners tend to have lower credit scores than higher income earners. When you have a bad credit score, things are a lot more expensive. You have to pay more in interest to borrow money like a mortgage or a car loan. For example, this 2024 base model Corolla on a 60-month financing, for someone with an excellent credit score, in this case 720 or above, the interest rate for the car loan is 4.75% APR. Your monthly payment will be $506. But for someone with a poor credit score, which is below 600 in this case, Toyota will charge you 18.29% APR. The person with the poor credit score will pay $693 per month, which is $187 more than someone with excellent credit score. Over the life of the loan, the person with the poor credit score will pay additional $11,220 to get the exact same car. For people living paycheck to paycheck, struggling with debt, or have bad credit, they may have no choice but to turn to other alternatives like the payday loans when they need money quickly. But this comes at a really steep price. Payday loans are known to be predatory, taking advantage of those in desperate situations. Maybe you are struggling to pay your bills. Payday loan will front you some money for a few days before your next paycheck. But the interest they charge is sky high. For example, in Texas, if you borrow $500, you have to pay back $641.50 in 11 days. This translates to an APR of 939%.
What?
The problem is that those with no other ways of borrowing funds are likely in a position where they can't pay back that amount in a few days. And if they fail to pay back such a high interest loan, this will result in a debt spiral that's very hard to get out of. You have to keep reborrowing money just to pay off the interest. It becomes a vicious cycle that can be very hard to escape. Rent to own is another common lending option that low-income families turn to for household items. These companies target cash-strapped families and provide lease agreements with low weekly or monthly payments. But these families end up paying significantly more than if they bought the item up front. Let's say your refrigerator broke down and you need a replacement right away. You may not have the credit or $679 upfront to get this Whirlpool refrigerator from Best Buy. But for $33.99 a week, Rent-A-Center will deliver the refrigerator to you. This may sound like a great deal and it's something you can afford at the moment, but you will end up paying 4 times more at $2,966 for the exact same refrigerator. Turning to lenders like Payday Loan or Rent-A-Center can be a very expensive financial decision. Some people might believe that poor people should just work harder and make better financial choices. But those in poverty have to constantly make hard decisions on how to spend their last few dollars. Pay for electricity or dinner for the family. Replace the broken refrigerator or go see a dentist for the toothache. And is there enough money to pay rent at the end of the month? These decisions are just routine for those with money, but for those struggling financially, these decisions can take on greater mental stress, which leads to poor decision-making. Studies have shown that economic distress impairs decision-making abilities, and this is called decision fatigue. It is why someone might turn to Rent-A-Center even though they know it's a bad idea. They might be exhausted from the decision fatigue and settle for a quick fix to put out the fire for now, even if the decision leads to more problem down the road. If you are in a lower income bracket, the odds could really be stacked up against you. You simply cannot afford to be poor. To break free from this vicious cycle, take intentional steps in your life to take back control of your finances. Look for online banks that do not charge you to access your own money. Banks like Capital One, Discover, and SoFi have no fees, no minimums, and fee-free ATMs. Avoid Rent-A-Center at all costs. See if you can find items on OfferUp or Facebook Marketplace to furnish your home. It may take more time and effort to search for what you need, but your wallet will thank you. And when there's an emergency like a car repair or a medical bill and you don't have enough money to cover it, Payday Loan is not your only choice. Many communities have charities, nonprofits, and other organizations that can help cover an emergency. Some credit unions also offer emergency loans for those with bad credit, and I will share these links down below. Thank you for watching. If you find this video helpful, please share it with someone that can benefit, and I will see you in the next one.